Hello, everyone. My name is Cheryl, partner at St. James's Place, Singapore. Thank you for joining us in today's webinar. The reason why we had put together this webinar is because there are many clients and friends who would like to get some insights on the current market situation, which is being affected by COVID-19, and wonder about the investment decisions that they should or should not be making. Also, thank you for sending us your questions. We want to ensure that this webinar is informative and valuable to you as much as possible. As some of you aren't existing clients of St. James's Place, hence we will start with a very brief introduction of our company, followed by our investment management approach. Thereafter, we will proceed to share about the impact of COVID-19 on the market, how we should react in our investments, and lastly, a Q&A session. To make this webinar interactive, there'll be a couple of polls which we will conduct during the presentation. These simple polls will pop up on your screen and you just need to submit your choice. At any point in time, if you have any questions, feel free to type them in the Q&A section, which you should see at the bottom of your computer screen. We will do our best to answer as many of your questions as possible. All right, without further ado, I'd like to first invite Wee Kai, Associate Partner of St. James's Place, to kickstart the webinar. Thank you.
Good morning, everyone. My name is Wee Kai. Like Cheryl, I'm a partner with St. James's Place. We are a FTSE 100 company with more than £100 billion of clients' funds under management. We specialize in providing highly personalized, holistic, and face-to-face advice to busy professionals and business owners like yourselves. We believe in pioneering advice-based sales as opposed to sales-based advice. And we do that by focusing on building and maintaining long-term relationships and putting clients firmly at the center of everything we do. One thing that sets us apart from other financial institutions is our advice guarantee. St. James's Place guarantees the suitability of advice given by our partners when recommendations are made. The reason we are able to do so is because of the robust due diligence we put in place. Without further ado, I would like to introduce our key speaker today. Prior to St. James's Place, Elson was the portfolio counselor within the wealth management team in UOB. His key responsibilities included creating investment advisory for the RMs and their clients. He is well versed in investment products ranging from unit trusts to bonds, structured products, equities, and FX. As the head of investment in St. James's Place, he plays a key role in providing market updates and funds analysis to partners and their clients. He is also involved in the research and strategizing of the investment portfolios for Asia. Elson's key strengths lie in having a strong product and market knowledge and the ability to provide quality advice and investment updates. Elson, over to you.
All right, thanks, Cheryl. Thanks, Wee Kai, and thanks everyone for attending this webinar. I hope it's going to be an insightful session for all of you here. Right, and thanks for the introduction, Wee Kai. Firstly, what I will do is, I believe there are a number of you who might not be clients of St. James's Place at this point in time, so I'm going to share a bit more about St. James's Place and how we manage investments for clients and investors. Then after that, I'm going to talk about the key topic of today, which will be COVID-19 and its impact on markets. And that will be followed up by how should we react to the investments that we are holding on to. So there are a few key principles that we should stick to, and I'm going to share a bit more in detail on how we do that and how we react to the markets in terms of COVID-19 and its impact. So first of all, to start off with an introduction on St. James's Place and how we manage investments. Firstly, to know just to manage. Bear in mind, we do not have our own fund managers, in-house fund managers. What we do is we engage third-party fund managers to manage our funds. And while we set the mandate, we have those control under arms. So that's a key difference. And then in terms of managers, these managers could come from anywhere across the world, be it in the US, in Europe, in Asia, in Australia, doesn't matter. As long as they're the best managers in the world and the most suitable to manage our mandate, we will be able to engage them. So in terms of selection process, there's no restrictions on where these managers come from. They can even be managing accredited investor funds. They can be managing retail funds or institutional funds. Similarly, we are able to engage them no matter what funds they are managing out there. And we just pass that mandate for them to manage accordingly. So we tap on their expertise and their team to manage the funds accordingly. Secondly, we have a strong monitoring process. Just to give you some figures, it's over 600 manager monitoring meetings on a yearly basis that we have conducted to monitor the managers, and it's with the help of independent consultants as well. So not just from the analysts within St. Joseph's Place. And if need be, we will be able to change managers appropriately. So the changes come at no cost to investors or clients. So some of the reasons for changes could include fund managers retiring, or there could be a change in their team in which that person could be a key contributor to the fund performances. And we observe that, and we realize there's a need to change the managers accordingly. And it could be a case whereby the managers did not follow the fund mandate that we have provided them with, and then they couldn't explain why so, or even due to performances, etc. But these changes are rare because managers, the managers that we brought on board are very much went through a strong due diligence by the investment committee. Just to give you an overview of the investment committee, is based in the UK, and then the investment committee will then select or manage the managers accordingly with the help of Stanford and Reddington, who are independent consultants. We also have independent consultants sitting in the board itself to provide independent expertise to the committee. And this is just an overview of where these fund houses or where these managers could come from. You will probably see familiar names like First State, Schroders, or BlackRock, or you could even see names that you may not be familiar with, for example, Aristotle or Magellan, but they could be the managers who could be performing or outperforming their benchmarks consistently over the years. So these are great managers that we can have on board, but you may not have heard of them. So just to give you a brief summary of the investment approach that we have here. Firstly, the freedom to change, which I had just explained. Secondly, is on the negotiated fees that we have with managers. Because of the high funds under management, which I think Wee Kai has shared earlier, we have more than 100 billion sterling in terms of funds under management, and we can use that to negotiate fees lower to the managers. And resilient fund flows, some of the conversation that I have with certain fund managers is that the fund flows that they experience with their own funds and versus the fund flows that they have with managing our funds is a big difference. They could see erratic changes when markets changes due to fund outflows or fund inflows. But in St. Joseph's Place, because the clients that we have on board are very much holding their investments for the mid to longer term, that fund flows become a lot more resilient. There isn't much of a big outflow when markets are tough or when things get challenging. The fourth point is on the whole of market, which means we can get access to a whole of market of wide range of fund managers that we have available to shortlist or to select, while we select the best one to manage the funds accordingly. And we are able to set the mandate due to our own preferences. We can customize the mandate based on what the investment committee deemed to be a lot more suitable for the client in St. Joseph's Place. And then in terms of portfolio transparency, we are able to see every single transaction that the manager does or perform. We are able to get daily access to what are the underlying holdings of each manager's portfolios. So that's the transparency that we get from the investment committee to view straight through to what the managers are doing on a daily basis. And that's how much control we have on a fund level. Just a brief overview in terms of the funds available. We cover almost all asset classes from government bonds, corporate bonds, mixed assets, UK equities, global equities, regional and country-specific equities, as well as emerging markets, global smaller companies as well. So you will notice that the investment houses could vary tremendously from one fund to another. Managers are very different as well. So that explains about us picking or handpicking great fund managers to manage our funds. Just a brief overview of our portfolios. We have the various portfolios categorized into various risk classes from lower medium to upper medium. We have the conservative portfolio and balanced, managed, and as well as adventurous, sitting accordingly to their individual risk profile. We also have the managed portfolio funds, conservative international growth, balanced international growth, adventurous international growth, which have that ability to rebalance automatically on a monthly basis. So just to give you an overview of the portfolios, a quick one. The conservative international growth portfolio consists of about 70% exposures to fixed income. The other 20 to 30% is in alternatives as well as equities. As for regional allocations, it's very much into developed markets. For balanced international growth portfolio, it's about a 50-50 allocation into equities as well as fixed income. Slightly more allocation towards Asia as compared to the conservative portfolio. Adventurous international growth portfolio is a full equity portfolio consisting of almost 70% into developed market equities and the rest, close to 30% in emerging market equities, which includes mainly Asia. So if you can see on the regional allocation, there's a lot more exposures towards Asia Pacific in general for this portfolio. Now, moving on to the key topic, which I believe most of you will be keen to hear about, will be COVID-19 and its impact on markets. So just to give you a brief overview of the impact of the coronavirus year to date. So we have seen cases started to rise rapidly in the UK, in Europe, and the US, somewhere in between middle of February. And that's where we happen to see governments or most countries implementing lockdowns measures since a large increase in cases. And that has brought down economic activities and that spurred markets towards a downtrend. So you can see the global equities, which is represented by MSCI World over here, that there's a selling off of close to almost 35-40% from mid of February to mid of March. The markets actually somehow bottom up briefly, as we can see from the chart itself. Global equities rebounded as central governments, especially in the US, announced further monetary easing policies, talking about unlimited quantitative easing, as well as decreasing interest rates to almost zero. So that's the case whereby we are seeing now for the markets as of end of April. And just to show you something a bit more interesting, this is the pollution map for March 2019 versus March 2020 for countries of France and Italy. So as you can see from the diagram itself, the red areas represents pollutants. So the redder it is, the higher the amount of pollutants it is from the chart. So if you can compare 2019 to 2020, both France and Italy experienced a lot lesser pollution, and that's because of decreasing economic activities. And all this is largely down to the decrease in due to the lockdown measures implemented by governments. Projected GDP growth, this is from International Monetary Fund. So what we can see here is that the projected GDP growth for 2020, most countries are going to be in the red, which refers to GDP growth of less than -3%. So that includes the Europe, UK, US, and you will see certain countries still having positive growth, and that includes India and China, which are some of the emerging markets out there, with the IMF projecting about 0 to 3% growth for this year. And just to illustrate a bit more about COVID-19 and its impact on the markets, based on this chart itself, which is represented by the S&P 500, you will notice that there have been various instances of virus hitting the markets all this while, with SARS, with H1N1, with Ebola, and right now we have the coronavirus that has hit us in late 2019, and we can see that impact by coronavirus is a lot bigger as compared to the rest of the viruses out there that has happened in the past. And that virus has spread further than previous outbreaks. So we expect the economic cost to be severe for the markets. And how quickly major world economies come out of lockdowns and when normal economic activity can resume remains an uncertainty to everyone. However, I think the key thing is how can we react and how do we manage investments during this period of time. I think we are going to face a lot of uncertainty, but what we can see from some of these charts which I'm going to show here will be some things that we can be certain about. Firstly, the first key principle that we should stick to will be time in, not timing matters. These two words sounds very close to each other, but there's a big difference in terms of what they mean. So we try not to time the market because from the chart that we see here, it shows the annual returns of the MSCI World Market, right? From showing positive annual returns in blue and negative annual returns in red. So if you notice throughout the years from 1986 till now, we are experiencing a lot more years that are positive and lesser years which are negative. And during this, from 1986 till now, we will notice that there have been a lot of big drawdowns whereby markets sold off from the peak to trough during this period. So you'll notice that, for example, in the year, if I bring you to year 2009, there was a big negative drawdown of minus 23%, but the year ended up with a positive 27% during this period of time. So it's important to know that we're going to experience max drawdowns, and whatever happens to the market at the end of it is something that we are not able to predict. But it's important that we spend time in the market with our investments. Okay. Next one. All right. This shows the rolling 1-year returns of the markets using MSCI World. So firstly, what you can see here in terms of the rolling 1-year returns will be represented if your investment horizon is just 1 year and you invest on a monthly rolling basis from 1995 till now. What are the kind of returns that you're going to expect? So from here, you could see that the range of that rolling 1-year returns could range from 50% positive returns to minus 40% in a single year itself. So if you have a short-term time horizon like 1 year, you're going to experience big fluctuations in your investments, like what we have seen for this year. You could see markets dropping 35-40%, and at the same time, you could also see markets rebounding with 30-35% upside. So it's something that we should know that markets can be really volatile over the shorter term. However, if you look at the longer term, if you were to use a rolling 10-year returns on global equities itself, you will notice that that volatility has decreased tremendously. And so if you were to set a rolling 10-year returns based on global equities, you could see the returns ranging from almost close to 0% to almost about 15 to 20% kind of range. So it's important that we make sure that we have a much longer time horizon and we spend time in the market to make sure that that volatility reduces over time. So if we to put the both charts together, we can see a big difference there in terms of volatility. So if you want to look at a strong annualized, a consistent annualized returns, you must ensure that your investments you are holding on to your investments over a longer period of time, rather than try to time the market and try to make decisions based on emotions. Now, this chart is showing you what happens if you invest 100,000 over 20 years through global equities, for example. So the bar chart on the left-hand side shows if you stay fully invested, that 100,000 will work out to be 233,000 after 20 years. If you stay fully invested, you do nothing about it. But if you just miss 10 of the best days in the market, meaning out of the 20 years, you do not participate in the market in 10 of the best days in the market, that 100,000 falls to 132,000. And if you miss 30 of the best days in the market, that 100,000 becomes a loss of about 30 over 40% of your portfolio. So it's important to note that we try not to time the market, because if you miss some of the best days in the market, you are not likely to get the full benefits of it. So for that, I'm going to have a quick poll, as what Wee Kai and Cheryl suggested, that we have a quick poll right now to see some of your responses to certain questions that we have.
So when markets are volatile, like what we're seeing now, would you sell off your investments into cash or to buy in more? You can choose one of the 3 options here.
Okay, all good so far? Okay. Okay, I'm seeing a very good response there. More than 70% of the poll suggested buying more in this current market environment. I think that's a very interesting one, and I think what I'll probably share in the next slide is something that probably relates to that poll. Well, if you were to look at history using S&P 500 and using US equity mutual fund flows as an example, we can see that from here, the green bars represent US equity mutual fund flows, and if they are below the black line, it shows that fund flows are in the red, which means are negative, which means people are selling off their US equities. And if it's above the black line, it shows that investors are buying more. So in this case, when we look at the 2008 to 2010, which is the global financial crisis, when the S&P 500, which is represented by the green line, drops in value, there's a lot more people selling off. So I think it's a good thing to know that most of us here are wary of that, because sometimes emotions can kick in when we invest. And when markets are down, it's probably not the best time to sell off and go into cash, which most of you realize that, which is a good thing. So what I'm showing here, I think is probably going to sit in very well with all of you here, or most of you here, that we should not be selling when markets are low, because it's something to do with emotions. And what we refer to here is in terms of the behavioral finance, and what they term it as the loss aversion bias, whereby the pain of losing money is twice as much as the joy of the same size gain. So when investors look at their portfolio reducing in value, they tend to get a lot more emotional when markets are tough. But that's probably not the best time for you to sell out into cash, but it's probably the best time for investors to look into going back into the markets going forward. So what we have, some of you may have seen some of this news before. The Dow Jones rebounded more than 11% in the best day since 1933. And that happens on the 23rd of March, whereby the Federal Reserve announces unlimited quantitative easing and to help businesses and individuals going forward. So that is a piece of good news. As well as this, S&P 500 books best weekly gain in 45 years. So this actually shows that the best day or the best week can come right after many days of selling off. So when markets are volatile, it could just happen. The best days could just happen in the midst of a high market volatility. And it's important to bear in mind that this could happen anytime, and we should always stay invested despite market volatility. And I've shown that if you miss out some of the best days in the market, your returns could be affected tremendously. So it's important that we stay invested. We do not miss out on the best days in the market. There could be a lot of cases that investors could get a bit jittery and panicky and they sell off somewhere in the middle of March or close to the end of March because they find that they could not take that volatility. But in the end, after that, they absorb the losses and they miss out further on the kind of upside the markets has had. So it's important that we do not time the market, we stay in the market. So the second point is to ensure that we look into diversification for your portfolios. It's important that we do not put all our eggs into one basket. So this colorful quick chart shows the various asset classes and how they perform in various years from 2010 to 2019. As if I were to bring your attention to maybe the gray boxes, which refers to emerging market equities, it could range from being the top best performing asset from one year and then the worst performing asset from in the other. So take for example, 2010 emerging market equities was the best performing asset, and then in 2011 it became the worst. So investors who could be just investing into emerging market equities in 2010 could face a rough ride in 2011. And due to the lack of diversification and that emotion of a rough ride could cause them to make irrational positions or actions, which means they could be selling off at the wrong time. So this could be a risk if you do not diversify your portfolio properly. So in short, it's important that we diversify our portfolios to achieve a much more consistent and sustainable returns over the mid to longer term. And how diversification helps in managing volatility. Firstly, before I talk about that, it's important to understand this key fact. If your portfolio drops by 50%, you need to have a recovery of 100% before it goes back to its original value. So the bigger the drop, the harder it is for you to go back up. However, if your drop is 30% and you just recovered by 70%, your net return is still going to be positive. So which means it's important that we manage volatility. If you do not diversify your assets, for example, if you are in a single stock in this current market, you could be experienced big sell-off of 50, 60, or 70%, depending on the sector or the stock that you're holding on to. And for it to recover, it's going to probably take a long time. So if you're not diversified in your portfolios, you may face a risk of finding it hard to get back to its original value or even making profits right after. Just to show you in terms of the Century Place portfolios, in terms of drawdowns, we have seen Q1 2020 being a rough period for equities. And we can see the various market index out there like FTSE 100, Euro stocks, MSCI World, S&P 500 dropping by close to 30% or even more than 30% in Q1 2020. And that's the maximum drawdown that we have experienced for these market indices. But what's comforting to know is that due to diversification, the portfolios in Century Place have done pretty well in terms of managing drawdowns during this period of time. And right now, we're probably going to hand it over to Cheryl to facilitate on another poll, and then for the Q&A session, if I'm not wrong.
Thanks a lot, Elson. Definitely a very, very informative sharing from you. So before we move to our Q&A session, can we just look at the screen for the poll to answer if this is the right time to invest? Okay, so perhaps before we show the poll results, let's go to the Q&A section first. So Elson, we have quite a few very good questions from people who are attending today. So perhaps let me start with the first question first. Is this recovery a dead cat bounce or temporary recovery in the market? Or do you think that there will be another market crash that will be coming?
Okay, very interesting question. And I think that's a question that most investors would have in mind. Unfortunately, I do not have an answer. We do not know what's going to happen to the markets going forward. It's hard to predict that, whether it's a dead cat bounce or a temporary recovery. But what we are certain of is maybe what I can share is why is the markets behaving in this manner. We have seen a recovery of 30-35% in the US equity markets. And why is that so? I think first thing to note, I think the first point is that company share prices may not reflect totally what the economy is doing. That's the first thing. But of course, over the longer term, what's happening to share prices will reflect what the economy is doing. But for certain time frames, that could not be the case, whereby the correlation could be low. It's important to note that, because what's important for company shares, because it reflects corporate profits and how growth is going to be over the longer term, and that may not be reflective in the current market environment. So that's one thing to note. And the other thing would be markets are forward-looking. So what the recovery is suggesting is that investors are looking at companies still doing well after a period of 3 or 5 years time frame. It's not about whether the market, the companies are going to do well right now in this current market environment, but in the future. And that's what's reflecting in the share prices of various company shares. So maybe just to illustrate an example, back in the financial crisis, we have seen in the 08 financial crisis, we have seen markets started to bottom out in March 2009, but then GDP growth only started to become positive at the end of the year. So that's a sign that markets are always forward-looking. They will be moving faster as compared to the economies on how they are growing in general.
Okay, thanks a lot, Elson. And Elson, we seem to be living in a new norm of unlimited quantitative easing, which creates liquidity in the market. And this seems to be the standard response of major economies like in the US, in the European Union or China. And even though recent earnings have been badly impacted, probably except for tech or pharma, how will this affect future investment yields?
Okay, firstly, what I can comment on quantitative easing is that it has helped historically. We have seen in the past how quantitative easing has helped economies to recover. So that's tested and proven that we can see quantitative easing helping the economies, and that is also being reflected in some of the share prices that we have seen so far. And of course, in terms of yield, we're going to see a period of time whereby investment yields are going to be really depressed or suppressed over time. It's because it's a new norm that we probably would have to be in, whereby interest rates environment is going to be low. We do not know how long this coronavirus is going to stay. It could stay forever, as what the WHO has indicated yesterday. So these are some of the uncertainties that we may need to be prepared for in terms of a low interest rate yielding environment. But what this points me to is also the risk of investors going into high yielding assets. If you are getting enticed by investments that's providing you with a 6, 7, or 8% kind of investment yield through a fund, I think that's something to be cautious about and to really look into its underlying. Because first thing is, if you are looking at a low interest rate environment and something is yielding you very high yield, that's something that you may want to be a bit more cautious on. I think that will be one of the key indicators for me to look out for when we are looking at yields.
Okay, thanks a lot, Elson. And with what's happening, what are the changes that our fund managers are making in this current situation?
Yeah, I think it's a good opportunity. I think, as mentioned by a lot of fund managers that we have on board, I think they see this as a great opportunity because there are quite a number of quality stocks that could do well in the next 3 or 5 years. But right now, their share prices could be a bit depressed because of what's happening to COVID-19. And so during this period of time, if I'm not wrong, between February to March, over a period of 1 month, the turnover ratio of most of our fund managers is at around 10%, which means they actually adjusted their books, 10% of their books during a 1 month period. The average turnover ratio for a typical fund is around 20 to 30% within a year, but what we have experienced is probably 10% within a month. So that shows that a lot of fund managers are looking into the market to look for a bargain, or cheaply valued stocks in this current environment. But bear in mind that most of our fund managers are not making knee-jerk reactions in this current market environment. Most of the fund managers that we have on board have a long-term time horizon, at least 3 to 5 years time horizon in their portfolios. So when such events happen, most of their holdings still stay intact because they have long-term good conviction about the underlying stocks. So there isn't much of a knee-jerk reaction from managers. What they are doing is probably to reposition slightly in terms of valuations, in terms of their portfolio, from a stock which may be highly valued right now to one which may be undervalued, but it proves to be a quality stock over the longer term.
Sure, Elson. And as an extension to this question, right? What are your thoughts about, you know, the oil and gas industry? Is it on a permanent decline already? And what do you think our fund managers are doing about this?
Okay, I think that's a very tricky situation. I think what we probably would see is that small oil producers are going to be hit quite hard in this kind of scenarios. I think with oil prices at such a level, some of the break-even points for the smaller oil producers may not be even maybe quite far off from this current level. So it may be a case whereby some of these small oil producers are going to be wiped out in time if prices stays low for a long time. I think this is what we have experienced in 2015, 2016 when oil prices were suppressed as well. So that could be a case whereby we may see. And of course, it's a demand and supply thing as well. So if some of that competition is going to be reduced, we could also see an uptick in oil prices when some of the big players starts to shrink some of their supply to increase their profits. So it could be something that might be worth managing. And I think it's a strong point when you ask about what our fund managers are doing to the books. I think one important fact which I can probably highlight is an interesting one, which is most of our global equity fund managers have a zero or almost underweight position to energy sectors. So that data was as of January this year, and that also explains the fact that some of our managers actually did pretty well when oil prices were down because they had almost nothing, no exposures, energy exposures during this period of time. And I think energy stocks could be really volatile, and it depends on the kind of mandate or the kind of strategy that the fund manager wants to look into as well. But in our case, I think managers are looking into quality and sustainability. I think sustainability is also one area that we should also focus on because it has been playing a part in managers' stock picking over the last few years. But I think it will become an even more important factor for fund managers going forward.
Okay, thanks a lot, Elson. And many Singaporeans, right, they are also looking into buying local stocks like SIA, DBS, etc., which they think that it should be backed by the government and enhance a safer choice of investments. What are your thoughts?
Yeah, some of these stocks they could be government backed, and one thing to note is some of these could be cyclical as well, which means when markets are bad, they can go really down south. And it's also important to note, in fact, Alistair Thompson, our manager from First State, who is managing our Asia Pacific Fund, actually made this comment about local banking stocks. He find that the local banks are being regulated by MAS, which is one of the best regulators in the world. So I think that there's no issue in us buying into some of those local banking stocks in general. I think he also has some positive views on the local banking stocks in general, which I think most of you here will be very happy to hear that our fund manager is also highly convicted in our local banking sector. But the key thing would be, of course, on diversification, which I touched on earlier. Some of these stocks, for example, SIA or DBS, OCBC, UOB, could face high volatility if you hold them as a single stock. Your portfolios could go down in one direction because of the high correlation among them being cyclical. And that could pose a risk to your portfolios if you hold too much of that. I think it's something to look at if you want to look at a core strategy that you have using certain portfolios and using some of those banking stocks as some of the side investments that you probably have high conviction on, and I think that's fine. I'm not a stock expert. I think the fund managers can do a much way better job than we do, and I think it's important to hear some of what the fund managers their thoughts are in terms of this.
Sure. And on a longer time horizon, where do you see the new economy in a post-pandemic world and heightened trade war with China heading? And now that China and US e-commerce sector is also aided by 5G technology.
I think the landscape is going to change quite dramatically going forward. I think technology is going to probably play a very big role in our lives. I think we wouldn't know how the COVID-19 or the virus impact could have. I mean, how it could turn out even after we ease lockdown measures. Things could go back to lockdown. Things could go back to slightly a bit more normal. But I think businesses are looking at different ways to manage their resources, to manage their businesses. I think technology is going to play a big role. And the one key thing which I highlighted here would be on sustainability. I think it's important to look at how companies can stay sustainable in this kind of environment whereby technology is playing a bigger role, whereby uncertainty like this kind of pandemics could have a big impact on businesses. I think it's about how business is going to restructure, what kind of business continuity plans they can have in place, what are some of the cultures or ways of doing things differently. I think these are important factors for a lot of companies to look at.
Okay, and earlier, we had the poll where we were asking the attendees here today whether is it the right time to invest now. Perhaps we can take a look at the results. Wow, so we have 90% who is saying that it is the right time to invest, and 10% says that it's not. Alson, can you comment about this? And also perhaps the last question that I have, from the attendees today is whether would dollar cost averaging still work in this market?
Yeah, it's good to know that most of you here are looking at opportunities in the market right now. I think what I've shared earlier, I think we probably will face quite a number of uncertainty in the market. But what we do not want I think there are two risks that we want to look at here. I think the first one is the risk of losing money. And then the other one is the risk of missing opportunities. I think it's a time for opportunities right now when markets are suppressed at this current level. When markets are volatile, it's probably the time for you to probably invest. But I think it's important that since we're going to face a bit more uncertainty, of course, you should start to invest if you have not done so. But of course, I think that the key thing is ensuring that you have a certain amount of money to be invested currently, and then phase in some of the money or cash that you have currently to invest in over a certain period of time, maybe a 5 or 6 months period. Because if you're going to face uncertainty, and if markets do go down south further, at least you have a good dollar cost averaging strategy that you have in place to manage your investments. And I think that would be probably the most prudent way to do so in this current market environment. So dollar cost averaging work well over the next 6 months or so. I think it's also to make use of that ability to maximize opportunities while we manage risk on the other hand. So it's about managing those two risks.
Okay, thanks a lot, Alson. I don't think there are any more questions from us, and it was really a very good session today, and I hope that all of you have enjoyed and learned something. So we will end this webinar. Thank you.
Right, thank you.
Thank you.
Thanks, everyone.